Okay, let's get started. Good morning and welcome to today's Tuesday Market Outlook webinar. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I'm going to be giving you my thoughts and analysis on the current market. So before we get started, just our usual disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Our agenda for today, as usual, kicking off with the major equity indices, highlighting those key levels. We have seen a significant decline from last week's Fed meeting, which we spoke about last week during the market outlook as well, saying that it could be an upside or a downside catalyst. Unfortunately, it was a downside catalyst, and we have seen the major indices break below, or at least the S&P and the Russell 2000 break below a key area of support. So we'll take a further look into that. From there, we'll be moving on to fixed income and commodities. We'll also take a look at the sector rotational model, highlighting which sectors are outperforming and underperforming the broader market. We'll take a look at some subsectors of interest, just the one that I have for you today. And we'll end today's webinar with some bullish and bearish market observations. Today, no real new positions other than maybe one new position. Maybe we're just going to be looking more at the previous ideas from the last couple of weeks and seeing how they performed. Seeing a good time would have been to cut losses, would have been for the bullish ideas, etc. Just because, I don't think we are at the end of the decline, but I do think that we should start looking at potential bullish opportunities in the long run once we do get to the end of this decline. But starting off here with the S&P 500 first. And as you can see, price did break below that 432, 430 area yesterday in the last session. Came back to retest it yesterday. So we had some bullish price action pretty much all around, but I'm not really convinced by the bullish price action. It does look more like a retest. And given the fact that futures are already lower this morning, we could see a continuation of this decline. So that bullish price action yesterday wasn't too convincing. I do think we're still very much vulnerable to a continuation to the downside, with the next key area of support sitting at 420 for the S&P 500, which is also the 23.6 fib level. So that will be the downside target that I have. And a big reason for this decline was because last week the Fed came out, or Jerome Powell came out and said, basically, he was a bit more hawkish than markets were anticipating. We know we'll probably get an interest rate hike this year before the end of the year. And markets are now pricing in only 2 interest rate cuts in 2024 compared to the 4 interest rate cuts that they were pricing in before the Fed meeting last week. So hawkish view all around, and naturally markets are now pricing that in. It doesn't necessarily mean it's catastrophic. I do think that, over the next week or maybe 2 weeks at the most, that's when you'd start to look for potential areas of support, potential buying opportunities. But right now, markets are definitely pricing in some more hawkish news, which is why we are seeing that broad-based decline. Now, on this chart, specifically on the daily time frame, we can see that the 50-period CCI has now approached minus 200, which is also an oversold condition. So we may not get as strong of a decline as we did over the last few sessions, but we could get a grind lower, given the fact that price is a little bit oversold here on the daily time frame. So 420, that would be the next key area to be looking out for the S&P. Now, moving on to the NASDAQ, looking at the QQQ ETF, we are seeing bullish price action at the same area of support, but again, not too convinced, not on the 350 area. I still think price has the potential to break below it. We do have additional support at 350, which is also vulnerable for breakdown. 340 is where I'm really looking at as a major area of support. We are seeing bearish price action here, a bit of capitulation on the weekly time frame, with the head and shoulders pattern somewhat forming, and around that 355 level being a bit of a neckline. I don't think it's going to be as big of a decline as we saw towards the end of 2021, early 2022, when price declined from the 400 area all the way to 270 after forming a capitulation as well. But I do think it does leave that 350 daily support level quite vulnerable for a breakdown. Price also not yet at an oversold condition. And overall, surprisingly, the NASDAQ is actually outperforming the S&P 500, despite the fact that it is a lot more sensitive to interest rates, perceptions on interest rates. So a hawkish sentiment from the Fed should actually mean that the NASDAQ 100 should be underperforming the S&P due to its makeup of more technology names that are more sensitive to interest rate cuts and rises. However, the NASDAQ is still surprisingly outperforming the S&P, but still a neutral to slightly more bearish outlook for the Qs here. Right, IWM, the Russell 2000 ETF, and the key level of support that was broken was 180. And we spoke last week that the Fed meeting could act as a downside catalyst for a break below this 180 support level. 180, 182 would be the support area, really. And that has actually turned out to be the case. Despite the bullish price action yesterday, price set to open a good bit lower this morning. And again, price is underperforming the large cap indices, the S&P and the NASDAQ once again. So small caps definitely want to avoid. If anything, I think going bearish on IWM here up until 170 could definitely be a play, given the fact that price has now broken below this 180 major support level. And 170 is a good target, given the fact that it's a 50% fib level as well, and also a major area of support. As we could see, price did find support at around March, April this year. So again, another bearish outlook here for IWM. Okay, TLT, the Treasury Bond ETF, big moves here for TLT after last week's Fed meeting. So we were finding some support just above 92. Price not really breaking below that level up until last week. And after the news, or after the more hawkish news, we have seen now a significant breakdown. Price breaking below 92 and heading towards the next major area of support, or it's pretty much there already, which is at 89. Now I had to zoom all the way back to pretty much 2010 to show you that why I'm viewing this area as support level, because that is where price, that's how far back we have to zoom to view this area of support. So price at 89, major support level on the weekly time frame, and it is bouncing higher from this level. So it's actually reacting positively. But again, like we have been doing all year, for TLT, you want to look into these rallies as potential selling points. I mean, unless the Fed starts to really pivot, TLT is always going to be under pressure from a fundamental perspective. So these short-term retracements higher could provide good selling points in the future. Right, moving on to the US dollar, and we have seen a breakout above a major area of resistance at 105.50. Now, with the more hawkish Fed comes a more stronger dollar due to higher interest rates. And we are seeing that dollar strength continue from early July all the way now towards the end of September. Breaking out of 105.50, which is a major area of resistance on the weekly time frame, as you can see. Bearish price action so far this morning, as in it's rejecting that 106 level, but by no means does this indicate a full-on reversal. The fundamentals do point to a stronger dollar. So I do expect the dollar to either stay near the 105.50 level or actually continue to rally, but may not rally with significant momentum, may be quite choppy, day to day. So US dollar, finding some very good underlying momentum as well. 50-period CCI remaining positive since early August and staying positive, all the way up until end of September already. So lots of underlying upside momentum here for the US dollar, which should see price stay neutral or continue to move higher. So with US dollar strength comes weakness in gold, and that is what we are currently seeing. So when we last spoke, gold was breaking above its 21 and 55-day exponential moving averages, but we have seen now a rejection at 180, which is also a previous area of support. 180 and 184 would be the two key areas that we'll be looking at. And price didn't quite manage to break above 180 and actually rejected it very strongly, and it is heading lower back towards this 176 level. Now, when it comes to forming a trading thesis here for gold, I think it's quite difficult given the fact that price is at a tight range. Overall trend is definitely bearish, and the ideal opportunity to have entered a sell position would have been 180, although even I would have been a bit scared, a bit skeptical at 180. I would have probably been looking for a breakout and continuation to 184 for better risk reward. but we didn't quite get that. And right now, price is quite close to this area of major support at 176. So the risk reward still doesn't favor the downside either. So in the middle of no man's land, but definitely heading lower towards 176 major support. Let's see what happens there. Because if we get a breakdown from there, it actually opens the door towards a move back down towards the 169, 170 level. So that's quite a significant decline here for gold. And again, because it's moving inversely with the US dollar, which is finding strength, we could continue to see weakness in gold. Moving on to oil, looking at light crude oil futures, and we are now starting to see some consolidation, but by no means is this indicative of a reversal. And this consolidation does happen to be just below this key area of resistance at 93. Price did reject 92 on the daily time frame, but still staying above its 21-day exponential moving average. So that's not a lot of bearish price action over the last 4 or 5 sessions. And we may get more neutral price action. It may respect 93 level of support as well. And the risk reward, again, as much as it favors the downside, given the fact that price is so close to resistance, the fundamentals with the supply cuts for oil do point to potentially higher price here for oil. So not one that I'm really willing to trade that much. I do expect prices to remain elevated, which could bode well for energy stocks that have a high correlation to oil prices. And given the fact that the broader markets are declining, the energy sector itself is a very strong outperformer because oil is actually continuing to rally or stay at elevated levels. So that's how I'd be looking at oil, but very tricky to assess it in even the short to long term because it is at a resistance level, respecting it for now, but these supply cuts could very well be a strong enough catalyst to see price break above that $93 level. So moving on to the sector rotational charts, we have 8 sectors in the improving and leading categories, and we have 3 in the lagging and weakening. So like I said, energy providing very strong leadership, continuing to improve on relative strength as the broader market declines, but oil prices remain higher. And it's just providing leadership now for the broader market. In the weakening category, we have technology continuing to weaken, heading towards the lagging category. That's going to drag the major indices down as well, given the fact that the S&P, is made up of 28% comprised of technology stocks. So the XLK technology names have a huge weighting in the S&P 500, and weakness in the sector could drag the entire index lower. We also have discretionary underperforming and communications coming back to life, moving up in terms of momentum, looking like it might actually rotate back into the leading category after just joining this weakening category only a few weeks ago. In the improving category, we have industrials rotating down towards this lagging category, utilities and staples starting to find momentum, along with healthcare, as market fears arise. Investors are going to be rotating towards the more safe haven or the more defensive sectors, but still a long way to go. We have financials also picking up some momentum, rotating towards the leading category, and industrials also losing a lot of momentum here and heading back towards this lagging category. So quite a lot of changes and shifts already in this sector rotational chart, and let's see what it looks like next week, because by then we'll have more time for the news to really digest and for this chart to have a better indication as to where the major sectors are heading to. Okay, so looking at TAN, which was a solar ETF idea from last week, and this was a bearish idea. We were looking at that area of support at 56 being broken, and price retesting it and heading lower. So far, this is working well for us, heading towards our downside target of 55, not far to go. But again, with equities approaching an oversold condition day by day, I don't want to be in this position for too long. So a few more days in this position, and definitely taking full profits at around that $50 level, which is a major level of support. Also on the weekly time frame, as you can see, the 50-period CCI is at an oversold condition already. So I'm going to be very much, looking at this name quite a lot just to see if there's any sign of bullish price action. on the daily time frame. And if there is, you may want to get out of this position sooner rather than later. So a bullish idea from last week was JP Morgan, or it's really from a couple of weeks ago, I think, where we saw a breakout and a long retest of this 144 level. And price is actually, despite moving lower over the last few sessions, is still respecting the bullish thesis by staying above this 144 level. We had a nice intraday bounce yesterday, and the financial sector as well, performing quite well despite the overall market downturn. And JP Morgan, the best major bank over the last few months. It has been outperforming its peers. So I think a bit of patience is required for this one, but I'm definitely looking to see how this performs over the next few days. It definitely needs to be back to 150 soon, and hopefully breaking out of 150, heading towards that 160 level. AMD was a bullish idea from last week with a double bottom at this $100 major support level. However, that has been invalidated because of last week's Fed meeting. We did see now that was a strong enough bearish catalyst for price to break below the $100 level. And because of that, it invalidates our thesis and definitely need to get out of this trade. Unfortunately, even though AMD is one of the better names in the semiconductor space, along with NVIDIA, it just, I think the whole macro outlook for equities did see price actually manage to break below this $100 level. Definitely keeping an eye for future bullish opportunities for AMD. If you are interested in semiconductors, it's definitely a name you want to be invested in, but right now doesn't seem to be the right time from an options trading perspective. So Qualcomm, another semi name, but we were bearish on this one at 114, given the fact that this is a resistance level, price is showing bearish price action there, and also rejecting its 55-day exponential moving average. Heading lower over the last few days, but yesterday's price action was quite bullish, close to a minor area of support at around 106. I am not going to read too much into that, though. Qualcomm is still one of the weaker semiconductor names in the short run, and I do think there's more room for this bearish move back towards 104. But 104 will be that take profit zone. So let's see how this develops over the next couple of weeks. And Royal Caribbean. So Royal Caribbean from 2 weeks ago was a bullish play. We were looking at the fact that price was staying above this 96, 98 level. Intraday rejections from that level, but wasn't quite moving higher, so a bit of patience was required. However, we have now seen a breakdown below 96, a close below 96, which has therefore invalidated this thesis. Looking back in retrospect, the best time to have gotten out of the trade was when price did gap down and closed below that $96 level. So that was when the thesis got invalidated for this bullish, neutral to bullish setup. And as you can see, it has continued to head lower. So unfortunately, Royal Caribbean, I think we may have to wait for continuation lower before looking for some good buying opportunities. We have 82 the minor level at 82, but I think 75, a price can decline there. That provides an excellent risk reward, longer term bullish opportunity here for Royal Caribbean. Okay, and the new idea for today is actually IBM. So IBM, starting off with the weekly time frame, you can see that price has been in this long-term range-bound market, even before COVID. It has been with resistance at 152. It's been respecting that resistance level, and there's been support, roughly at around, let's say 115 to 120. So with the strong range-bound markets, and given the fact that markets are declining broadly, IBM was rallying towards this 150 level, strong rejection of 152, major resistance, and it is heading lower. So this provides a good long-term bearish entry point. And ultimately, over the next few months, you really want to target that 120 area once again. However, the way I would look at setting up this trade is actually doing multiple trades during this downtrend. So maybe targeting this 137 area first or 140 area first would be a better idea. Wait for a retracement higher, and then look for another good risk reward bearish entry point for another move lower. So not one trade for this big move, but rather breaking it up into 2 or 3 smaller trade setups, and to take advantage or to take maximum advantage of this bearish move or potential bearish move back down towards this 120 level. Okay, and with that, that is all I have for you today. Thank you so much for joining me, and I hope to see you next week, Tuesday, for another Market Outlook webinar. Have a great trading week, everyone.